Welcome to Modern Money Intelligence, or MMI. We're here to give you the structural clarity you need for smarter thinking, better decisions, and modern success. In today's explainer, we are diving into what was literally a historic week in the global economy. We've got record-breaking AI deals on one side and a cross-border jobs blowout that just sent total shockwaves through the markets on the other. Let's get right into it.
Here's a quick look at our agenda for today. We'll start by exploring the new AI infrastructure asset class, then move into that massive cross-border jobs blowout. After that, we'll look at the resulting market turbulence and the upcoming SpaceX IPO, before wrapping up with our MMI caveat and conclusion.
All right, Section 1, the AI infrastructure asset class, the Anthropic era. So, the biggest story in AI history literally just dropped. Anthropic raised $65 billion. That puts them at a staggering $965 billion post-money valuation. With this single move, they have officially blown past OpenAI in the private market. Now, you might be wondering, is this just more AI hype? Well, no. This massive valuation is driven by some incredibly strong fundamentals. They're projecting $10.9 billion in revenue for Q2 2026. But here's the real kicker. They are projecting their first ever operating profit of $559 million. So at an annualized run rate approaching $44 to $47 billion, that $965 billion valuation is sitting at roughly a 22 times forward revenue multiple. Not too shabby at all. But honestly, the real innovation here isn't just the valuation, it's how this is actually being funded. Think about it. Historically, tech startups relied heavily on traditional VC equity, right? Which usually means diluted ownership and pretty strict balance sheet limits. But foundational AI needs massive, incredibly expensive computational clusters, and venture capital simply doesn't have the sheer capacity for that. So we are seeing a major pivot to institutional chip financing. Private credit is coming in and completely transforming how AI infrastructure gets funded. Let's follow the money to see exactly how Apollo and Blackstone structured this specific $36 billion private credit deal. It's fascinating. Step 1. Institutional debt funds a special purpose vehicle, basically a pop-up company created just for this deal. And that vehicle buys custom Google TPU chips. Step 2. Those chips are leased directly back to Anthropic. And finally, Step 3. To protect the lenders, Broadcom actually backstops the debt against defaults, meaning if Anthropic somehow misses a payment, Broadcom covers it. So what is the big takeaway here? Why is institutional capital suddenly flooding into chip financing? Well, this transaction officially shifts AI from being a risky, venture-backed R&D play into the realm of institutional capital markets. Wall Street is moving in because chip financing gives fixed-income investors a highly secure yield backed by physical, hard assets, the compute hardware itself. And for the AI companies, they get to scale massively without giving up any board seats. AI compute is officially an infrastructure-grade asset class. And by the way, this is definitely not just an American phenomenon. Over in Europe, SoftBank just committed 75 billion euros to build a massive, low-carbon AI infrastructure hub in France. They're targeting 5 gigawatts of data center capacity by 2031, making it the absolute largest AI infrastructure investment in Europe to date. Okay, moving on to Section 2, cross-border jobs blowout, the macro reality check. So Friday's employment data came out and it absolutely shocked both sides of the border. In the U.S., non-farm payrolls surged by 172,000 jobs. That completely smashed the consensus estimate, which was sitting way down at just 85,000. It was a massive beat that basically caught every single economic model totally off guard. Looking a little deeper under the hood, the U.S. unemployment rate held perfectly steady at 4.3%. And while a lot of that hiring was concentrated in specific sectors like leisure, government, and healthcare, this blowout data tells us that the underlying U.S. economy remains on very, very firm footing. But wait, look north of the border, because we saw an even more massive surprise in Canada. The Canadian economy added an astounding 88,000 jobs in May. To put that in perspective, analysts were expecting just 10,000. It completely obliterated expectations. And what you really need to take away from this Canadian surge is the quality of those jobs. This wasn't part-time work. It was driven entirely by full-time employment. We're talking 154,000 full-time positions added, which pushed the Canadian unemployment rate down significantly to 6.6%. Right, let's head into Section 3, Market Turbulence and the SpaceX IPO, Public Pullback versus Private Mega IPOs. So, ironically, all this great news for Main Street turned out to be pretty bad news for Wall Street. Despite those incredibly strong jobs numbers, the S&P 500 actually dropped 2.64% on Friday. That snapped a 9-week winning streak, and it happened precisely because the real economy is doing so well. Here's the logic behind the drop. That incredibly strong labor data immediately stoked fears of higher for longer interest rates. It basically killed any lingering hopes for an immediate Fed rate cut. We saw the 10-year Treasury yield spike to 4.53%, and investors started aggressively taking profits on the recent AI rally. Tech giants like Broadcom and nvidia took a hit, dragging down the broader indexes.
Now, I want you to compare that public market interest rate anxiety to the absolute unbridled confidence we're seeing in the private markets. Looking ahead, all eyes are on the ultimate mega catalyst, the highly anticipated SpaceX IPO. It perfectly highlights the massive premiums that investors are still willing to pay for deep tech.
Get this, SpaceX is targeting a breathtaking $1.75 trillion valuation. They are skipping the traditional price discovery range entirely and setting a fixed IPO price of $135 a share. Their goal? To raise somewhere between $75 and $85.7 billion when they make their public debut on June 12th under the ticker SPCX.
If the public market successfully absorbs this offering, which, by the way, trades at an astonishing 94 times 2025 revenue multiple, this single event would be the largest IPO in stock market history, and it could officially mint Elon Musk as the world's first trillionaire.
Finally, Section 4, our MMI caveat and conclusion, structural risks.
Before you go adjusting your portfolio, please remember, this explainer is for educational and informational purposes only. These assessments do not constitute formal financial, investment, or career advice. High capital transactions and equity allocations carry serious structural risks that require your own personalized due diligence. Always consult with licensed professional advisors.
So we'll leave you with this final thought. As institutional capital and structured credit fundamentally reshape global tech, which market reality will ultimately define the rest of 2026? Will it be the robust, debt-financed private infrastructure bets, or the nagging interest rate anxieties of the public markets? Stay ahead of the curve by staying informed. If you found this intelligence valuable, make sure to follow, like, and subscribe to MMI for your weekly dose of modern success. Until next time, keep thinking smarter.